Hi. Welcome to the Bursa event. My name is Pauline Young, and then I'm a licensed financial planner. I'll be talking about the topic of investing for women, how to get started. Okay? All right. Okay, let's start. This is my background. I'm also a book author for a few books, investment and financial planner, and I'm a licensed financial planner for the Securities Commission and also the Bank Negara. And okay, so today's topic, we're going to talk about basically there are two things that we want to look at. Why we need to invest, number one, and then number two, how we should go about doing it. And there's according to a statistics by the S&P Global Survey, it says that only 26% of the women invest in the stock market. Okay, so this figure is rather low. So that means there are only 26% of the women actually invest in the stock market. So how can we improve this number? So that is my objective today. So hopefully by sharing with you guys, I can actually turn some of the misunderstanding into some encouragement for you to invest in the stock market. Okay, so first, why do we need to invest in the stock market? Now, if you to look at stock market, a lot of time we think that, well, for me, when I just started out as a investor or investing in the stock market, I actually think that investing is more like a short-term thing. Like you try to make money in the stock market and you want to make some quick bucks out of it. But after I became a research analyst, okay, in 1997, and that was the Asian financial crisis. So there was a time when I started to see that, wow, we can actually make money from the stock market, and the price, whenever there is such a great opportunity, you can actually make so much money out of the stock market. And then I also learned about financial planning. Okay, so this learning about financial planning has turned my life, because actually, if we can look at investing together with financial planning, we are actually looking at a more holistic investing approach. So this is why I want to share with you guys about investing, and look at investing as a small part of our overall financial planning, wealth planning. Okay, so here we are looking at life stages. So in life, we go through different stages of our life, and we may not have the same objective for everyone, but more or less we have the same or similar kind of objective. So basically, when you just started out working, you probably would think about buying a car, and then you will getting married, buy a house, children education, retirement, traveling, and buy bungalow and legacy. So all these are the objectives throughout your life cycle. And when you look at these, you are looking at different stages of your life. You make certain decisions. Okay, and the decision is important because it will affect your retirement stage here. So what I'm going to show you is that how to accumulate your assets in terms of the stocks and in terms of any other assets like properties, and so that you can retire comfortably. Okay, so if you to do some quick math calculations, if you look at, you started at age of 25, you start work at the age of 25, and then you retire at the age of 55, so that will be 30 years of working years. Okay, so you're looking at 30 years of working years, and then you look at your retirement age. So if let's say you're looking at 85 of your lifetime, so that means from 55 until 85, you will be another 30 years of a retirement age. So you will have to work for 30 years, and then you have to retire for 30 years. So what if you can live up to 95 or 105? So that means you will probably be retirement age longer than you think. So how to ensure that you have a good retirement? So then we have to look at this accumulation stage, and this accumulation stage we will focus on the properties and also the stocks. These are two major sources of assets whereby you can increase your wealth. Okay, and let me show you something. Now, I would think that this time, we all know that we are in a recession. Okay, so when you are in a recession, just like when I told you in 1997, 98, I started investing. I was a research analyst, and then I saw how the price actually increased so much within a short period of time. And then, of course, there was only one recession, and I experienced a few other recessions after that. And then in this minor recession or major recession, and you are able to capture or to take advantage of the low price in the stock market, and then to increase your wealth further. Okay, so this is a golden opportunity. So for example, okay, if I can use the pen in the here. Okay, so if you look at these, so we are looking at this is 75. Okay, so we are looking at this is in the 70s and the 80s. So this is 75, and then this is 85 or 86. Okay, and then you are looking at this one is 1998, 98. And then this one is 2000, 2001 dot-com bubble, 2001. And then this one was 2008, the subprime crisis. Okay, now this one is called the GDP. Okay, real GDP, annual real GDP growth rate. Now, what does annual real GDP growth rate means? GDP stands for gross domestic product. So you are looking at the wealth or the financial status of a country. So if you are looking at the financial situation of a country when it is in a negative or zero situation, it means that you are actually in a recession. So how many times of recession did we have for the past 50 years? And you can count based on your one hand, you can count the number of times. There were not many times that our GDP figure actually touches the zero or negative level. So if let's say we are in the state of this negative GDP, isn't it a golden opportunity for you to take advantage in the stock market? Okay, so if you look at it over here, we see that our stock market here is 75. And then the GDP is almost zero. It wasn't even negative, it was almost zero. Then you see the 86, we have a -1. Okay, then the worst, of course, was the Asian financial crisis. So it was a -7.4%. Then the dot-com bubble, almost zero. Then you have a subprime crisis of -1%, 1.5, and then you have it here, 2020. Okay, so 2020, 2020, okay, 2020, what was our GDP? It was all the way down to negative -5.6%. Okay, so that was our last year annual GDP growth rate. It was a -5.6. So if you to look at these figures, this -5.6 was actually not far from this -7.4. So if you to look at the extent of the recession, the worst recession was this, and this 2020 last year was considered the second worst recession for the past 50 years. So that means what? That means it is golden opportunity for you to invest in the stock market. You just have to give yourself some time. Investing in the stock market is not a quick rich scheme. Okay, you definitely do not look at it as a quick bucks kind of a thing. You have to look at it as a long-term thing. So for me, I give it a time until the time frame of 2023. Okay, so I'm looking at investing now, and then you have to invest with some spare money, and then to leave it for 2 years, okay, until 2023, when the pandemic is over, when the market is recover, then you see the prices go up again. Okay, let me give you some example. In 1998, I bought public bank at 1 ringgit. Okay, can you imagine public bank at 1 ringgit? So that was in 1998, and I sold at 4 ringgit. Okay, so of course, if you to tell me that, oh, you shouldn't have sold it, now it's even more. But the thing is that within a short period of time, when you see that your portfolio increase, you have to take profit. Okay, then along the years, so these are the times whereby I bought CIMB Bank at 250, around here, 2004, 2003, 250, and then I sold at 650, okay, in a few years' time. So that means I was willing to hold for about two years, okay, even 3 years. So then you are looking at this kind of opportunity. And then also in the 2008, I managed to buy my Maybank at 3 ringgit, and then within 1.5 years, it became 6 ringgit, double up. Okay, so whenever you are in this severe kind of market downturn, it is a good opportunity for you to increase. So back to that here, where we say that we want to accumulate our assets, right? So number one, we want to accumulate stocks. Okay, we want to accumulate stocks. And how do we do that? So you look for opportunity in a depressed, whenever the GDP is 0 or negative. Okay, whenever the annual GDP is 0 or negative, you invest in the blue chip stocks with dividends. Okay, invest in the blue chip stocks, and you wait for it to double up. So for example, Maybank, let's say 2008, I bought at 3 ringgit. Let's say I bought 10 lots. Okay, 10,000 shares. And 1.5 years later, it became 6 ringgit. And you sell half of it. Okay, so you left 5 lots, 5,000 shares here. So that means when the price double up, you sell half of your shares, you are actually getting back your capital. So that means what? That means these stocks here is cost-free for you. FOC, cost-free. Okay, and these are all dividend stock. So once you get it for free, you just leave it there, and then you continue to do whatever you are working, whatever, you just continue. And this one is like a passive income. And because if the industry is a long-lasting industry like a banking sector, even until you retire, you just keep it, and then every year you just have to collect your dividends. And then whenever there's another round of a recession, because probably in your lifetime you wouldn't have too many times, it will be like maybe in my case, I have already seen 5 times. So maybe in your case, you probably will see like in a person's lifetime, maybe 5 to 10 times. Okay, so as long as you find this opportunity, you keep investing. And then you can collect more, accumulate more and more of these FOC stocks. Okay, and they must give you a dividend. Along the way, if you find that the dividend no good, and then the company have lost its fundamentals in terms of their financial ratio and things like that, it's not as good as before, you can always sell them. Okay, you have to manage it. You can't keep it and then forever. You definitely have to manage it. So then you will have to make sure that for this accumulation stage, you have to accumulate as much as possible of these stocks, because they are FOC already, so you don't have to bother about the next financial crisis. Don't bother, because they are free. So you just keep it there and then just collect the dividends. Until you are retired over here, you will have a lot of portfolio over here. Okay, and all these are the stocks that you acquire in a long time. Okay, then you will be very happy for a retirement over here. Okay, so that is for stocks. Then, of course, you can always think about how to invest in the property. So I would think that for any recession, it is always good time to invest in the properties. Okay. Although today we are supposed to talk about stock, but then properties, it is a form of an asset class whereby we can find some good opportunities here. Okay. So over here, in your earning years, so these are your earning years, golden years of earning. So you have to earn as much money as you can, provided you have a stable job or you have a good business. And at the same time, you must also know how to invest your extra money. Okay, whenever you have some savings, you invest. So sometimes you don't have to wait until recession. Along the way, you can invest in a unit trust on a regular basis. Okay, so now I'm giving you many options here. You can invest in the stocks, you can invest in the properties, and you can even invest in the unit trust. As long as you are investing in the stocks or equities or properties, you are investing in the assets class or even gold. It's also a form of asset class. You can fight the inflation because our objective here is that we want to fight the inflation so that we can reach a very comfortable retirement age. Okay, so I'm going to talk about why we need investment first. Then only I will talk about how we can go about doing it. Okay, so now we just let me finish up with this why we need to invest. So number one, we need to invest because we want to have a better retirement. Okay, and number two, we want to invest because it's a golden opportunity, because now it's a recession time. So recession time, you have to, when others are fearful, you have to be greedy. Okay, so that is what Warren Buffett said. So that's how you need to invest when others are fearful. So, and I'm not saying that it will recover within a short period of time. Okay, the stock market, it will take some time. Even in the past history, you saw that whenever we have the severe recession, it doesn't recover, within a short period of time. It will take some time. So you have to be patient. 2 years. So I'm giving you a time frame which is 2 years. By 2023, then you can start to sell your portfolio. But before that, you can keep accumulating. Okay, from now onwards until next year, you just have to keep accumulating. Whenever you feel that there's a sell down or whatever, you just have to buy some of the blue chip stocks. Okay, later I will tell you how you can go about doing it. So that's number two. And then number three, why you want to invest? Because as a woman, okay, and also as a mother, and also as a lady, we want to increase our wealth. Okay, as a family, you need to manage the household, and then sometimes you also want to increase the wealth of the family. So that's why I find that women are very good in picking the stocks, because women are always good in bargaining. So when you are coming to the stock market, right, you are always looking for good value. So in life, in the supermarket, in the whatever shopping that you're looking at, you always look for bargaining. So you just have to apply that mentality into the stock market, and then I'm sure you can find some good value, undervalued stocks. Okay, so that is the three reasons why I think that women should invest in the stock market. Okay, then I'm going to tell you how we can go about doing it. Okay, I'm going to show you some of the figures here. I haven't shown you just now. This is the stock market. So just now I showed you the GDP figure. So you can see that during these years, there's a recession, and then when we met back to the stock market, we see that this 98 recession, 2008 recession, whereby you see the price dropped like 70% over here, and then it was a V-shaped recovery over here. Although you see that it's like a V-shape, then you have another dip down. Okay, so but the second dip is always higher than the first dip. Okay, so then you have a W, and then it go up. Then the next one is the 2008. So 2008, you see that the share price from here dropped about 40%, 30 or 40%, because if you're looking from here to here, and then half of it is around here, so here is about 40%. And it has a V-shaped recovery. Okay, also there is a W sign over here. So in terms of technical analysis, we are looking at a double bottom. Okay, double bottom means that it's a reversal. It's a reversal trend, and then you will see that the stock market recover. Okay, and just now we saw that in 1986, right? So this is 1986 also, but beyond that, you can see that there are some mild recession here. Sometimes it wasn't a recession, but then it was a bad sentiment, like stock market sentiment wasn't that good, but it wasn't to that reach that stage of a recession, but that was not, the sentiment wasn't good. So the stock market has a fall over here, and then this one is like a major recession, then it has a deep fall. Okay, along the way, you have some small drop, and this small drop is like a 10 to 20% kind of a drop. Okay, some is like, for this one, maybe it's about 30% of a drop. Then over here, we can see that we are in this category here. So last year, we saw our KLCI index drop all the way down to 1,200 points. So that was the lowest that we experienced in the past 10 years, okay? And then we had a rebound to about 1,600 points, and now we are at about 1,500 points. So where are we? So I would think that we are in the path of recovery, okay? We may not be visiting this 2020 level, low level again, but we are low. Okay, we are still low, so it is still good time for you to invest. So you just have to pick up your bargain hunting skill, and then to find some good value, blue chip stocks with good dividend, and then you can invest. Okay, so of course, if you can see, I teach you one simple technical analysis way to spot the market top. There's one good way for you to spot when is the market top, because sometimes if you can spot the market top before it crashes, and then you sell some of your position, then at least you do not get stuck in the situation. Okay, so one way is that you look at this pattern. This is a multi-year, this is like a 30-year chart pattern, and then you look at these. Did you see like a M shape here? Okay, so this is like a M shape. Okay, so whenever you see like a M shape, it means double top. Okay, double top means it's a major chart pattern, and then the price will crash. Okay, then you see that another time over here, this one, if you to zoom in, it's a shape like this. Okay, this one we call it a head and shoulder. Okay, head and shoulder, also a market top pattern, whereby it signifies the end of the bull run. Okay, so this is a bull run. So this signifies the end of it, and then you see the market crash over here. Then over here, we see there's a big market top over here. You see, this is a huge market top. Over here, we saw that this market top is made from 93 to 97. It's about 4 years time. And then this one is about 07 to 09 is about 3 years time. But this M here is a big M. It's the biggest M of all that we see compared to this two. So it means that we are looking at the market top. And this market top is considered quite a severe market top. So we are looking at this M, whereby it is looking from the 2012 until 2020, so it's about 8 years. So this market top is formed with 8 years of data, and which means what? Which means that when will we get the bottom and then recover? Most likely, I would think that it will be 2022. Okay, 2021, 2022, we're going to see some recovering, but then until after 2022, then we see a clear recovery for our KLCI and our economy, okay, judging from this chart pattern here. Of course, technical analysis is not always 100%, but at least it does give you a guideline, okay? Okay, so next, how do we go about investing? Okay, number one, we need to, okay, these are certain steps over here. So I'm just going to write over here. Number one, we need to identify our objective first. Okay, so these are investment plan. It's a proper investment plan from a financial planning perspective. That means you must do things in a proper manner so that you treat investment as a business to you. Okay, just like you want to do a business, you have to think properly how to plan for everything, and the money, how do you buy certain resources and equipment. So same thing here. For the stock investing, you treat it as your business, and then you have to treat it as if it is a very, very serious business. So you do not allow any form of wasting. Wasting in the form of, sometimes, why I say greedy? Because sometimes you will hear some tips from your friend. And then when you hear some tips from your friend, they will ask you to buy this, they will ask you to buy that. And then maybe you will, buy without really looking at the fundamental. So then your money will be lost. Maybe you will gain, okay? But at the same time, there's a possibility for you to lose your money. So the chances of losing is there. So therefore, if you to treat it seriously, you do not let your money to lose so easily, then you have to plan it properly. Okay, so we have one step here. Okay, so it's a series of steps here. So I'm trying to see whether I can use my pen to write. Okay. So this is your objective. So this objective is actually looking at your financial goal. Okay, your financial goals. You can have many goals. You can have a short-term goal, medium-term, and a long-term goal. You must have certain objective so that you know what you want to select. The kind of stocks that you want to build has to gear towards your goals. It has to be in line. So, for example, you can have two portfolio. Okay, so you can have a short-term portfolio, which is about 2 years. So I can put here that I can have a short-term portfolio, and then I can have a long-term portfolio. And this short-term portfolio is about 2 years. I will not invest, like within 2 years, I want to see the results. Okay, so that's my objective. And then for the long term, I want to see more like a retirement. Okay, so it could be 10, 20 years. Okay, so maybe 10 years. Then, okay, then what can be the goals? Okay, there are many goals here. So you can have the most common goals that everybody has is the holiday dream. Okay, nowadays I know everybody is kind of like not thinking about holiday so much, but it is a good dream. Okay, it's good to dream about holiday dream. Okay, and this holiday dream is to have 20,000 of it has to be specific. Otherwise, what is a goal? A goal has to be specific goal. So I have to spell it out everything clearly. So it's like 20K to tour to my dream destination. Okay, I will not tell you what is my dream destination, but it will cost me 20K. Okay, so then it will be 2 years. So that means now 2021 until 2023. So we are looking at the 2 years time frame. So invest now, then 2 years later, hopefully I can have that dream, realize my dream. Then, since this is like a luxury dream, okay, because it's a holiday dream, so it's kind of like luxury. So when it is kind of like a luxury kind of a dream, you can have the strategy. You can construct a portfolio whereby the strategy can be a bit risky. Okay, more aggressive. So I call it more aggressive portfolio, whereby I should be looking at higher risk sectors. Okay, so number one is your objective. Then I put here, okay, since I have a space here. Number two is my sectors. I need to select the sectors. Okay, I need to select the sectors. Now in Bursa Malaysia, we have 13 sectors: technology, healthcare, consumer, industrial, REITs, properties, construction, utilities, telecommunication. Okay, there are 13 of them. I cannot remember everything. So you don't have to invest all the 13 because you don't have the time. Okay, so you just have to select up to 5 sectors. Okay, I always tell people to select the 5 sectors that you are very comfortable with, that you understand the industry well, and of course it has to match with your objective. So in this case, okay, so in this case, I'm looking at this kind of like a luxury dream. So if I didn't hit the target, so the reason why I choose a more risky stock is because if I didn't hit the target, I will go to, let's say I only make until 10K. So then if 10K, I can go to a local or maybe nearby Asian region country. Okay, so that means what? That means that luxury goal is something that you want to have a aggressive portfolio. If you can hit the target, that means you can make the money, the kind of profit is good, then you can go for the dream. But however, if it doesn't, because it's risky, right, you can probably lose some money. So if let's say you didn't reach the target, then you go to a nearby area or local tour. Okay, so that means that is the objective here. Okay, so what are the stocks here? So there are a few stocks, a few sectors that are actually considered of a higher risk. I'm sure you can tell me what are those. And actually, I'm looking at a few perspectives because now we are in a recession. So one is that I choose a sector that is of a growth sector. Okay, if it's of a growth sector, probably the price will go higher. Okay, that's number one. And then number two, I can probably choose a sector whereby it is the worst hit sector. Okay, why I say that? Because currently we are in a lockdown mode, and then we have to identify which are the industries that are of a lesser, that means the worst hit. So which industries actually cannot do business because of the lockdown. And of course, they will lose the revenue. Okay, and of course, when they lose the revenue, then the share price will go down dramatically. Okay, so we identify those because after all, the target is 2023. So once the everything recover, so you will have to see that your share price probably will double or hopefully triple. Okay, so then we identify these two area. Okay, from these two perspective. So number one, the growth sector will be, I'm sure you know. Okay, will be this one. Okay, I have to write this one. Technology. Okay. Technology. So this one will be looking at the technology. And then number two, we are looking at the healthcare. Okay. Because everybody is concerning about healthcare because currently, okay, let me write first. Okay, currently what we are looking at here, it's a public health crisis. Okay, we are looking at public health crisis whereby the healthcare sector will have all the resources, all the money will go into. So this will be the growth sector. And in the past, these are the financial crisis. Okay, there is all the crisis or the recession, there is a reason behind it. So if you can identify the reason behind these crises, it was the financial crisis whereby the banking industry, okay, stocks were the worst hit stocks during this time. Whenever you have a financial crisis, the banking stocks were worst hit because basically you have a lot of non-performing loans and the revenue drop and then the price drop. Okay, so it reflects because of that situation. So that's why you identify, and then this probably will be the commodity crisis. So each of these crises, you identify what was the crisis. Then you target at that, because after all, we want to go for a more aggressive portfolio whereby we want to reach that luxury dream. Okay. Then we also look at, these are the growth sectors. Okay. Then we also look at which are the sectors that were worst hit during the pandemic. Okay. I'm sure you will have some idea. Okay, let me write down. So the worst hit will be the properties. So property sector. And then we have the construction. So this, that means what? That means we will have to make a bold estimate. Okay, that means that these two sectors, hopefully by 2023, it will kind of recover. Okay, so these two, and then we have to plus one more or more stable one, because these are growth and then these two are risky because we do not know when the economy will recover, right? It will be of a higher risk. And then we have to add one more stable one, consumer sector. Okay, so we are looking at technology, healthcare, properties, construction, and consumer. And if let's say you want to add on, because I have 5 here, if you want to substitute one of these with another sector, also can. Okay, for example, other sectors are like energy, because energy can become like a black horse. Why? Because currently we are in a lockdown, so the oil consumption is low. So what happens if let's say we are in an open up economy? So everybody will be consuming the oil, petrol, and everything. Assuming we haven't gone into the EV car, because EV car is a bit far from us, we still need the petrol. So definitely, and then the plane and the airplane aviation all needs petrol. So probably because of this, demand will increase, and then the energy stock probably, I will not say 100% guarantee, but probably will increase as well. Okay, so we are looking at these high probable sectors whereby we want to maximize the growth, okay, the kind of a price appreciation for the stocks. Okay, so then these are the sectors that you select. Then only you select the number 3. Then only you select the individual stocks. Okay, so these individual stocks, I will not go through because not much time that I have. Okay, so you will have to select. Okay, so I'm sure you know the name. What are the names? Okay, just for education purpose, I just mentioned the name. It's not recommendation, it's just mentioning the names. So the names are, in terms of the market capitalization, the technology sector, the biggest market cap is Inari, and then the MPI, and then you have other technology stocks like VS, Dufu, Vtrox, you have the Frontcan, D&O, all these semiconductors. Okay, they are the growth sectors, and the best part, they export to the overseas. Currently in Malaysia, lockdown, and we are not really recovering well, but other countries are not locked down. China, Singapore, US, they do not lock down, and these are our 3 largest export partners for Malaysia. So if our export partners are not closing up, in fact their economy is doing well, so we should also look at our exports market. Okay, so those companies that involve operations that export to the overseas, and I'm sure their revenue is being able to maintain. Of course, during this lockdown period, their operation-wise, they cannot operate their factories and they cannot have a production, but that is only temporary. So it's like 1 month or 2 months, right? I wouldn't expect this to be prolonged. So after these 2 months, it should be operation again, and then things should be looking good again. Okay, so now it's just a bad sentiment time. So you just have to pass this bad sentiment time. Okay, then we look at the healthcare. Okay, what are the healthcare stocks? The healthcare stocks are like Door Pharma, Pharma Niaga, and then Apex, and then IHH. All these are the healthcare stocks, and also the glove stocks. Okay, the glove industry is also considered the healthcare because the glove is under the equipment, the supplies, equipment and the healthcare supplies. So it is under the healthcare. Okay, so there are so many stocks here that you can choose. So you don't, you look at how much you have. Okay, you look at your amount of money. So if let's say you are looking at 20K, so looking at 5 sectors, 20K divided by 5 is how much? Okay, divided by 5. So that means each sector you can only invest up to 4K. Maybe because let's say you just want to invest in 2K, okay, or maybe 3K, because you need them to double up so that to reach your 20K, right? So that means you have to invest 10K. Hopefully for this 10K it can double up to 20K. Okay, so that means I need to reduce it to 2K here. It's actually not much you can invest, but still you can, okay, because our minimum share is 100 shares. Okay, so still you can. So okay, then what are the names for the properties? Okay, the properties, there are many developers, good developers, so you just have to use your observation. Sometimes you don't have to look at the fundamentals in terms of the numbers like ratio, but you look at the development. Okay, if you are familiar with the properties, you look at the properties market, and then you see that the developers, what kind of development they develop. Okay, are those development very good response? So if let's say they are, then most likely they are the good developers. Then you can buy some of their shares. Okay, you don't have to buy the company or two. Okay, so now everything is low price. It's a discount because we always want to go for discount for our grocery. And if everything, clothing, everything, 50% discount is good. If you can get 70% of discount, is actually very good. So if you're looking at properties, actually can find some 50% or even up to 70% of a discount. And even some of the construction company, you can find this kind of a discount. It's a real fact. Okay, you just have to, I will not name the name, but then you just have to look at it. Okay, you have to go and look at it. You can see them. And the consumer. Okay, the consumer include a few industry beside the food and beverages. You have the retail, because currently the worst hit industry were the retail sectors. Okay, the retail, which is under the consumer. And then we also have the travel and tourism, right? So these are the worst hit. So when the economy recover, so these things all will improve. So the travel and the leisure. Okay, so therefore the airline industry is also part of it. And then the supermarket, and then the clothing department, all these stores, all these are here. Okay, so you just have to choose one or two, okay, under here. So in fact, you can't choose much, but like one or two from here. So you have a very small portfolio, and then see whether this can double up. Okay, treat it as an experiment. Okay, then And the next one, a long-term portfolio. So today I'm going to teach you two portfolio. One is that to build a more aggressive one for a short-term basis, and then the other one is more on a long-term. Long-term is that means it's more stable, and then you look at the income stream. Okay, so for long-term, what do you look at? You look at the dividends. Okay, so I will write somewhere here the long-term. Okay, right here. So the long-term dividend, okay. So under the long-term, I will have the dividend. Sectors will be mostly concentrating on the dividend and the growth. Not growth, but a bit of a growth as well. So dividend plus growth. So this one is like the growth plus the worst hit, right? So this one is dividend plus growth. So most likely I will still have my technology over here. Okay, technology and my healthcare still here. But now I want to put some banking stocks here. Okay, banking. And, oh, it's slanting. Okay, never mind. And what else give you good dividends? Utilities, right? Okay. Oops. Then one more. So I have banking, I have utilities, and would you like to have REITs? REITs will be something now is of course very depressed, but maybe in the in the future when it recover, it may not be that depressed. So maybe you can put some REITs over here. Okay. So you have to find what type of REITs are. There are so many types of REITs. You have to find the right type of REITs. Try to avoid office kind of REITs, but more on retail because the economy will recover. So the retail or the hospitality or something like that. Okay. Okay. So there I have the 5 here. So how much retirement? This retirement is actually for a longer term. So you are looking at regular investing. So the strategy is different. You see the strategy for this short term can be sometimes like a lump sum kind of investing strategy, but for the long term, I usually go for regular investing, meaning that every month when I have the extra money, instead of putting the extra money into the bank for savings, I put it in the stock market now. Because the bank will not give me high interest. The bank can only give me 1.5% of interest, which is like nothing. Okay, so I have to put it in the stock market. So now, of course, I can't see much gain, but then in the future, I will see gain. Okay, so I must have that kind of a confidence. So then I will invest in the stock market for long term on a regular basis, on a monthly basis. So every month end or beginning of the month where you receive your paycheck, okay, the first thing you buy share first. Okay, you don't pay your whatever utility bill, whatever, you buy share first. Okay, that's a form of an investment and a form of a savings. Then after that, then you pay all your monthly daily expenses. So you're looking at long-term investing, okay, and savings as well. So for this strategy, every month end you invest. For example, this month I invest in technology. Then maybe in August month, beginning of the month, when I got my paycheck, I invest in some healthcare stocks. And then the next month, following month, I invest in the banking. And then each month I alternate. Okay, I only buy one sector for each month. Okay, so that I want to keep myself I don't want to overexpose too much in one sector. Okay. Like maybe 500 ringgit or 800 ringgit or even 1,000 ringgit. So it depends on your ability and your budget. Okay, or if you want, you can save it until 3 months. Okay, every 3 months, then with that amount, you can invest. So you invest every 3 months. So you make it like a habit. Okay, which are the months that you can invest? There are a few months that I recommend, okay, based on my study and my research. There are a few months that the market usually go through a low cycle, and the low cycle months are, so I hope to give you as much information in this 1 hour as possible. So the low cycle months are February, May, August, and November. So July, we are now in July, so we don't invest in July. We invest in August. Okay, so when 1st of August, you receive some money, paycheck, then you invest in some of the stocks here. Okay, the stocks that you have identified. So this is like a plan to you. So everything's all written down in a nice plan. It's called your investment plan. So you have to write down very specifically what is your financial goal, and then what is your time horizon, how many years you want to reach that goal, how much money you want to reach that goal, and then how much money you want to invest every month or every 3 months or whatever. What is your investment injection, your capital injection? How frequent is your capital injection? And then after that, that one is the beginning part. Then after that, you have to write about your sectors. Okay, which sectors you want to select. So you select aggressive one, then you select the aggressive, the worst hit sectors, and then plus the growth sectors. Hopefully, these will all increase, double up in value. Hopefully, no guarantee, yeah, but hopefully. Then only you identify the stocks, individual stocks. Okay. Now, when it comes to individual stocks, I do have some recommendation. So these are the financial ratios. Maybe you understand some of the financial ratio, maybe you don't, but I'm going to write it down. So if you do not, then you just have to refer to the internet. Okay, nowadays you can get a lot of information from the internet. So the financial ratio, I look at the number 1 is the PE ratio. Okay, the PE ratio, the lower the better, but not too low. Too low also means something is wrong with the industry. About 12 to 14. Okay, 12 to 14 is good. Nowadays, 12 I think is good because it's recession. Number 2, dividend yield. I would prefer 4% and above. Okay, number 3, debt equity ratio. Debt to equity ratio. Now, this debt to equity ratio is how much debt a company has, not more than 0.5. Then number 4, ROE, return on equity, at least 12%. And then number 5, the market capitalization. That means how large or how big is a company based on their market price times the number of outstanding share. So the market cap, I would prefer mid cap to large cap. Okay, not too small cap. So above 500 million market cap. Okay, and number 6, the cash reserve. The cash reserve, I want to see that it is above 10% of the market cap. 10%. That means if let's say the market cap is 1 billion, I want to see that this company has a cash reserve of 100 million. Okay, so then that means it's kind of like a safe company with abundance of liquidity, and then it can go through the down cycle and things like that. Okay, so After you have select these stocks based on these criteria, then you have to record. Okay, you put it in a nice Excel worksheet, and then you put that as your portfolio, short-term portfolio. Give a name for that portfolio, whatever name. Then you monitor it. Whenever you receive dividend, you just put it in the Excel worksheet, and then because the dividend is considered part of your revenue, okay, it is, you have to record it. So all this, you do a proper recording. I'm sure ladies are very good in doing this kind of a detailed job, very systematic job. Okay, so you record it down, and then you will have to monitor your performance. Okay, and the performance monitoring, usually I would think it's about every month I will monitor, and then if let's say you do not have that time, maybe every 3 months. Okay, so for me, I prefer every month. And hopefully by this target 2020, 2023, and then if let's say you reach your target, then of course you can go for your holiday. Okay, and then for your long term, it will be 10 years later. Then 10 years later, you see whether this effort of savings will it help you to reach your retirement goal even faster. Okay, so I think okay, that's about it. For this 1 hour, I think I have covered quite a bit. So hopefully, everyone will have a strong knowledge about the approach in how to get started in investing. Okay, by having a systematic plan. And I think that's about it. That's all. Thank you, everyone.